Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. Bit of housekeeping to begin this week. There was no note released on Saturday morning. As I mentioned last week, I was headed to Scottsdale for a golf event and couldn't find the time to put together a note, but you should expect to hear from us again very shortly, perhaps even prior to this Saturday, if we have something we want to release this week. We've gone from 80 degrees in golf to having received 10 inches of snow over the last 2 days back here in Vail, Colorado. To begin this week, a little additional housekeeping, which is we're going to get our first jab on Wednesday. Maybe it'll be our first and last. I don't know. For those who didn't get an opportunity to read the Wall Street Journal interview this weekend, it was with the Johnson & Johnson CEO, and he went through the differences between the adenoviruses and the mRNA viruses, vaccines, that is. It was a very good read. I'd suggest having a look at it for everyone. It's a broad discussion there about the implications for T-cell resistance, which should last longer than building antibodies, and does make a pretty good case for Johnson & Johnson's vaccine, but of course you would expect that from Johnson & Johnson's CEO. As far as the pandemic goes, the number of cases has flattened out in the East, and in the South it's still at a bit of what I would describe as an uncomfortable level. It's falling in the West. Good news for us in Arizona and Colorado, but you'd like to see these prevalence start to fall a bit further. But obviously the number of vaccines being received by the public continue to go up. So that's all pretty good news with a decent outlook. As far as what we thought was important to note this week, first of all, we did not get the extension of the supplementary leverage ratio exemption for cash and treasuries that we had hoped for and thought the Fed would be willing to grant. It seems to us that the politics of banking remains quite acute 10 years after the financial crisis, or more than that now, 12 years after the financial crisis. That does not bode particularly well for the large banks through this business cycle. We've written as recently as last week in our Outlook note about the potential disintermediation that could take place from fintech, and whether the culture and regulatory environment is conducive to these banks really competing with this disintermediation trend, which seems to be picking up momentum. Our first chart this week does show that large bank holdings of treasuries have started to fall. Now, that could be because bill issuance has tailed off as the Treasury needs to drain their TGA account. We'll have to see how that demand develops over time. It is pretty clear, we've seen some analysis, that most of the largest banks are well beneath that supplementary leverage ratio, or SLR ratio, so they could add treasuries. But you can also see from that first chart that there's been no loans that have been added to speak of for years. And then we move on to a table which shows you, and we included this in the email that'll go out with the podcast, so you can see it there as well as during the video that's going to be created from this. But you can see that there's been no real estate or addition of real estate assets through the pandemic. That's because the government's effectively nationalized mortgage lending through Fannie, Freddie, and Ginnie Mae, and the use of non-bank originators. The capital requirements, risk-based capital requirements, are so high on just creating mortgages in whole loan form and servicing those mortgages that doesn't make sense for large banks in particular. Some small banks will do it, but on balance, this sector has been pushed out of the banking industry, which we don't really think is a good thing, particularly if you have unconventional income streams. It's harder to get loans because you don't fit government mandates for debt to income ratios and the like. And you can see that in commercial and industrial lending has been the only category where there's been any lending over the last year during the pandemic. That's through the small bank sector, but that was facilitated by BPP. So this is really the government creating a lot of capital, sending it to or cash, sending it to the public, and then using the banking system to finance it via the Treasury market. This is classic financial repression. It's not good for bank profitability, and it does call into question how the sector is going to perform through the cycle. For now, the sector is going to have a very strong credit cycle. They're going to be able to release a lot of reserves during earnings season, but it'll be curious to see how the market reacts to credit versus really getting net interest margin expansion, really getting loan growth. Those things are not going to be evident this quarter in particular, and it's unclear they will be. And with decisions like the SLR decision, which basically makes the banks finance all this Fed asset purchases, as well as the drawing down of the Treasury account, to us, this is just effective nationalization of the banking sector. And the banking sector, if they can't get return on assets back to where it was in 2018 and 2019, and they can't get return on equity back above 10%, the group will stop performing well. We're not there yet, but later in the year, we may very well be. So that's it on the banking sector. We'll write more on this in the coming weeks. We wanted to go through a little bit of a macro recap of what happened last week, at least our perspective on it. We haven't said very much about the Fed. It does look to us like the market is pushing back on the Fed idea that they won't be raising rates. We never really thought forward guidance was particularly efficacious. The Fed can talk till they're blue in the face about what they're going to do 3 years from now, but they don't know what they're going to do 3 years from now. And the market is looking at a much steeper curve, rising inflationary pressures, and is saying that the Fed is not going to make it all the way to 2024 before they hike rates. And we are pretty sure that that's indeed correct. Again, we'll write more about this in the coming weeks. But as far as the incoming data last week, we added a chart on import prices, and we continue to make the point that the global financial crisis was a disinflationary or deflationary shock. And the pandemic was an inflationary shock. And you see those import prices continuing to rise. The question is whether it will be transitory or will persist through the cycle. We've noted that deglobalization was already decelerating as a trend in the 2010s relative to the 2000s. An index we created of Asian trade increased at a 15% annualized rate in the middle of the business cycle from 2001 through 2008. It only grew at about 5% last cycle, and we think it'll decelerate further. Businesses are just not going to want to have their supply chain stretched all over the world. So we don't think it's transitory, clearly. We also added a chart on retail sales just to show you, despite this extreme volatility in the month-to-month numbers over the last 4 months, a weak number in November, a weak number in December, an incredibly strong number in January, that was revised even higher, and a weak number in February, that the year-on-year trend continues to go up. And this is even before easy comparisons begin in March. So clearly consumption of goods is exceptionally strong. Now there'll be some transition to services as the lockdowns ease in the coming months, but nonetheless, consumption is surging because of all these, in part because of all these transfers, and in part because that household sector was not over leveraged going into the crisis. So that's really good news for our second quarter outlook, which is that we'll have maximum economic velocity and maximum liquidity injections into the second quarter. We would also note, though, that there is policy drags on all this, continuing claims trend, which we didn't add a chart this week, but those trends have been basically trendless. And since the extension of the unemployment insurance and enhanced unemployment insurance, the additional $300 a week, the drop in total continuing claims across all the programs, including the pandemic programs, stopped at the end of December, rose in January, and has remained at a fairly high level. So we do think there's some disincentives to go look for a job having been created by all this. We'll see how that goes when restaurants open back up, and maybe teachers unions even decide that they should go back to work. And the one other notable thing we saw last week was we got 2 of the 5 regional Fed surveys, the Empire State Survey from the New York region, New York Fed, and the Philly Fed survey, the capital spending plan for March look exceptionally strong. This week we get Richmond and Kansas City. Dallas comes the following week. That's what comprises our capital spending plans index. And it looks like we'll have a pretty good pickup in March. One of our calls for the second quarter is that capital spending will really start to pick back up, not just in equipment, but also in software and perhaps even in structures. We'll start to see physical plant capital spending plans accelerate in the second quarter, and that should persist for some time. So final note we would make this morning would be an administration spokesperson was making the rounds on CNBC and Bloomberg and talking about everyone paying their fair share and tax policy. So they're out pitching the Biden tax plan. Fairness is determined by the central government in their view of the world, not by the spontaneous economic order. In other words, what the public is collectively willing to pay for. So we view this as a real macro risk if the Biden plan goes through as advertised. We've said on a number of occasions that we think it's worth a 10% equity market correction, 5% because of the multiple hit associated with higher capital gains rates, and roughly 5% associated with lower earnings growth associated with a higher corporate tax rate. The individual piece, we don't think is a big market driver, but corporate sector tax reform, tax receipts is not a big percentage of the total, but corporates are right in the crosshairs of this fairness doctrine. So as that persists, the market will undoubtedly begin to struggle with that. So we'll see how that goes. So that's it this week. On balance, the second quarter outlook remains strong, but we see policy risks starting to bubble up. They're bubbling up in the financial sector. They're bubbling up in the labor market, and they're going to bubble up in a tax policy way as well as the Biden administration continues to pitch their Build Back Better plan. So have a good week, everyone. Barry Knapp from Ironsides Macro. If you're not already a subscriber to our research, we'd love you to consider becoming one. Remember, there's a number of ways to get there. You can pay for the individual research. If you're an institutional client, you can onboard us to your voting platform, or if you're an institutional client that pays with commissions, we are a senior advisor to Macro Risk Advisors, and you could enter into an agreement, do some trading with them, and pay for our research that way as well. So Barry Knapp, Ironsides Macro. Have a good week, everyone. Thanks.